Hello and welcome. Join us as we delve into the September 2023 stock market slump dynamics, navigating the last month's slump and beyond. We'll dissect the factors that led to the S&P 500's worst monthly performance of the year, and how the Federal Reserve's hawkish stance, surging oil prices, and other factors played a role in this downturn. The stock market in September 2023 took a hit, with the S&P 500 slumping around 5%, marking its worst monthly performance of the year. This downturn was primarily due to the Federal Reserve's hawkish stance on economic and rate projections, surging oil prices, mixed economic data, and a potential government shutdown. However, it's not all gloom and doom. The market is now the most oversold since fall 2022, and there's potential for a recovery. Understanding the September slump. September and October are historically challenging months for the stock market, often characterized by increased volatility and falling asset prices. This year was no different. The Federal Reserve's hawkish stance on interest rates, coupled with a potential government shutdown, a major strike by auto workers, and surging oil prices, all contributed to the stock market's downturn. Despite these challenges, the oil and gas industry managed to rise by 1.6% over the past week, showing resilience in the face of broader market trends. Sector performance breakdown. In terms of sector performance, all 11 sectors of the S&P 500 ended in the red in September, with the exception of energy. Real estate was the biggest loser, falling nearly 8%, followed by utilities with -7% and technology, which fell about 5%. Energy, however, managed to gain 3% over the month, showing that even during downturns, there are sectors that can buck the trend. The impact of climbing bond yields and oil prices. Bond yields are on the rise, along with oil prices. The 10-year Treasury yield topped 4.6% recently, and if this trend continues, it may spark fears and lead to the third consecutive year of losses for the bond market. This could have broad implications for other asset classes and currencies, with higher bond yields potentially making the dollar more attractive. Economy overview. Understanding the gross domestic product, GDP, growth rate is crucial to grasp the health of the economy. The Bureau of Economic Analysis' third estimate on the second quarter's GDP growth provides an insightful look into how the economy has been performing. Key findings. 1. The second quarter GDP growth rate remained constant at +2.1% from the second estimate, slightly outpacing the +2.0% growth rate observed in the first quarter. 2. Despite a downward revision in consumer spending, the negative impact was partly offset by upward revisions in non-residential fixed investment exports and inventory investment. Revision of past GDP readings. The report also revised GDP readings for each first quarter from 2020 to 2022, with the aim of removing the residual seasonality component, which was not considered a factor. 1. For Q1 of 2020, the economy was revised to show a contraction at a -5.3% annualized rate, steeper than the previously reported -4.6%. 2. The overall GDP for 2020 was adjusted up by +0.6%, indicating that the economy contracted by -2.2% that year. 3. The Q1 of 2021 was revised to show the economy expanding at +5.2%, slightly lower than the previously reported +6.3%. 4. The GDP for 2021 was slightly revised down by -0.1% to +5.8%. 5. For Q1 of 2022, the economy was revised to show a contraction at -2.0%, a steeper decline than the previously reported -1.6%. 6. The GDP for 2022 was slightly revised down by -0.2% to show the economy expanding by +1.9%. In summary, these revisions and estimates provide a more nuanced understanding of the economic growth patterns over the past few years. Looking ahead, Q4 2023 view. As we head into the last quarter of the year, U.S. economic performance, Beijing's growth measures, OPEC+'s oil supply strategy, and the post-COVID monetary tightening cycle are expected to shape the investment and business climate. While U.S. growth is expected to slow, measures taken by Beijing could help achieve its 5% growth objective. However, rising oil prices could act as a headwind for growth. Key events this week. Tech enthusiasts and investors alike have some exciting dates to mark on their calendars in October. Two tech giants, Google and Samsung Electronics, have major events lined up. Google's big reveal. On October 4th, Google is set to hold its Made by Google hardware event. This event has always been a platform for Google to showcase its latest products, and this year it is no different. The tech giant is expected to unveil the Pixel 8, Pixel 8 Pro, and the Pixel Watch 2. These new additions to Google's hardware lineup are eagerly anticipated by consumers and investors alike. Samsung's Developer Conference. Following Google's event, Samsung Electronics is not far behind with its Developer Conference scheduled for October 5th in San Francisco. Samsung plans to highlight platform innovation at this event. Attendees can look forward to learning more about SmartThings, Bixby, Knox and Tizen, key elements of Samsung's technology ecosystem. In conclusion of this video, despite the September slump, there are signs of potential recovery. Investors should keep an eye on sector performance, bond yields, oil prices, and macroeconomic trends as they navigate the investment landscape in Q4 2023. Thank you for watching. And please don't forget to subscribe to our channel and give this video a thumbs up if you found it valuable. By doing so, you'll stay updated with our latest insights and strategies.